As we look at the boards right now, Opendoor Technologies Inc., trading under the ticker OPEN on the NASDAQ, is sitting at 7.46 USD, which represents a massive 1.03 increase or a 16.02% jump during today's session. While a double-digit move like this usually triggers a wave of retail excitement, the real story here is not just about the price action, but about the specific institutional positioning occurring beneath the surface of this volatility. Most people look at a 16% move and assume it is just a reaction to a singular headline or a general sector rally. But what if I told you that this specific price point is actually the result of a massive unwinding of short positions that had been betting on a total collapse of the iBuying model? The expectation among the general public for the last 18 months has been that Opendoor was a dead company walking, a victim of high interest rates and a stagnant housing market. However, the reality we are seeing today suggests that the market is beginning to price in a structural shift in how residential real estate liquidity is handled as we move into a period of more predictable monetary policy. There is a common belief that the business of buying houses directly from consumers and flipping them for a slim margin is fundamentally broken. You hear it on every finance news outlet and read it in every bearish report. People think Opendoor is just a leveraged bet on home prices. But that is the expectation. The reality is that Opendoor has spent the last year transforming its balance sheet and its inventory management systems to operate in a high-rate environment. And today's price movement is the market finally acknowledging that the company might not just survive, but actually dominate a much leaner, more efficient real estate market. When you look at the volume today, we are seeing a significant spike that suggests more than just individual brokerage accounts moving the needle. We are seeing institutional conviction. It is the kind of activity you see when big players move away from purely speculative platforms and start looking for companies that have actually cleared their high-cost debt and managed to keep their spreads healthy despite a frozen housing market. When you think about the broader landscape of online investing and how individual investors interact with stocks like this, the narrative often gets lost in the noise of daily fluctuations. On platforms like Robinhood or through a Fidelity trading platform, the retail crowd often chases the green bars without understanding the technical floors being established. Today's move to 7.46 USD is significant because it breaks through a psychological resistance level that has held the stock down for months. This is where the tension between expectation and reality becomes most visible. The expectation was that high mortgage rates would permanently kill the demand for the convenience Opendoor offers. The reality is that in a low inventory market, the certainty of a cash offer becomes even more valuable to a seller who needs to move quickly to secure their next property. This utility is what drives the underlying value, and it is what the market is finally starting to reward. If you are using Interactive Brokers platform or managing your own individual brokerage account, you have likely noticed that the volatility in Open is not for the faint of heart. It is a stock that requires a level of patience that many who engage in self-investing simply do not have. But if you look at the data, the institutional activity suggests a long-term accumulation phase. They are not looking at the next 15 minutes, they're looking at the next 15 months. We are seeing a shift where the risk-reward profile has tilted in favor of the bulls because the downside has been so thoroughly priced in over the last 2 years. The market had priced Opendoor for bankruptcy. When a company is priced for death and it shows even the slightest sign of robust health, the upward correction is often violent, which is exactly what we are witnessing today with this 16% surge. Let's talk about the actual movement we've seen today. The volume is tracking well above the 30-day average, which indicates that this is not a low conviction drift upward. It is a concerted effort by buyers to reclaim the $7 level. This matters because it changes the delta for option sellers and forces a repositioning across the board. Whether you are using SoFi Active Investing or a Fidelity mobile app to track your positions, you can see that the momentum indicators are flashing overbought in the short term, but the structural breakout on the daily chart is what really holds the weight. This isn't just a random pump. This is a reaction to the macroeconomic environment shifting just enough to give Opendoor the breathing room it needs to prove its unit economics. For those of you who have been following the real estate sector, I want you to comment below how many shares of Opendoor you currently hold and what your average cost basis is. It is always interesting to see how the community is positioned during these high volatility sessions. Do you think the housing market is truly turning a corner, or is this just a temporary relief rally before another leg down? Your perspective helps everyone get a better sense of the sentiment on the ground. Now, to understand why today's move is so aggressive, we have to look at what Opendoor actually does and how it has changed. At its core, Opendoor is a technology company that provides a platform for residential real estate transactions. They use proprietary algorithms to price homes and offer sellers a guaranteed, fast closing. In the past, they were criticized for overpaying for inventory and getting stuck with homes that were depreciating in value. However, their more recent reports show a much tighter control over their buy box. They've become much more selective, focusing on higher margin opportunities and reducing the time a home sits on their books. This pivot is crucial because it reduces their exposure to interest rate fluctuations, which is the primary fear for anyone involved in online investment within the real estate space. If you look at how people manage their portfolios, whether through Schwab Intelligent Portfolios or through active self-investing, the weight given to companies like Opendoor usually reflects a high beta strategy. It's the kind of stock that people buy when they are looking for outsized returns and are willing to stomach the drawdowns. But the older reports that showed massive losses are becoming less relevant as the company slashes its operating expenses. The reality is that the Opendoor of today is a much leaner animal than the one that went public. They have integrated more deeply with partners like Zillow, turning what was once a fierce competition into a synergistic relationship that drives lead generation without the high customer acquisition costs they used to face. The broader market narrative is often shaped by what happens with giants like Nvidia stock or Apple stock, but for a mid-cap player like Opendoor, the catalysts are much more specific to the housing cycle. As we look at the future outlook, the primary catalyst will be the stabilization of mortgage rates. Even a slight decrease in rates can unlock a massive amount of pent-up demand from sellers who have been locked into their current low-rate mortgages. When these people finally decide to move, the convenience of a platform like Opendoor becomes the path of least resistance. This is the reality that is beginning to clash with the expectation of a permanent real estate winter. There are, of course, significant risks. If inflation remains sticky and the central bank is forced to keep rates higher for longer, the cost of carrying inventory will continue to pressure Opendoor's margins. Furthermore, competition from traditional brokerages and other iBuyers who have managed to survive could squeeze their market share. However, the sheer scale of Opendoor's data and their ability to price risk in real time gives them a moat that is often undervalued by those who only look at the surface-level financial statements. When you use tools like interactive broker stock trading or research through Fidelity Wealth Management, you have to look beyond the top-line revenue and focus on the contribution margin per home. That is the metric that will ultimately decide if this company becomes a staple of the American real estate landscape or a cautionary tale of overexpansion. The current movement we see today, with the stock at 7.46 USD, is a testament to how quickly sentiment can shift. It was not long ago that the consensus was that the iBuying model was fundamentally flawed and that no one would ever want to sell their home to an algorithm. But the reality is that the consumer values time and certainty. In a world where everything is moving toward instant gratification and digital efficiency, the idea that a home sale should take 6 months and involve dozens of showings is starting to feel antiquated. This is why platforms like Robinhood Crypto and various investing sites have seen such a surge in younger users who expect this kind of digital-first experience in every aspect of their lives, including real estate. As we move into the final months of the year, the focus for Opendoor will be on their ability to scale back up without sacrificing the efficiency they have gained during the lean times. If they can prove that their model works at higher volumes while maintaining their current margins, the stock could see a re-rating that takes it far beyond these single-digit levels. The tension between the expectation of failure and the reality of operational improvement is where the greatest opportunities for investors usually lie. It's about finding that gap and having the conviction to act on it before the rest of the market catches on. In summary, what we are seeing today is a significant moment for Opendoor. The 16.02% jump to 7.46 USD is more than just a daily swing. It's a signal that the market's expectation of a total collapse is being replaced by the reality of a resilient, tech-driven real estate platform. We have looked at the institutional volume, the shift in the housing macro environment, and the internal improvements the company has made to its business model. While the risks of a volatile